Hey everyone, Douglas here. Welcome back to the MMT Macro Trader. In this market recap for Monday, July 24th, 2023. Nothing terribly exciting happening in the equity space. Stocks really just kind of consolidating sideways. Last week, really exactly what you would expect heading into an options expiration week. Oftentimes, you'll see price consolidate around the highest build of gamma at that strike price. By the end of the week, it was right around 4,600, dipping to about 4,550, right where we saw price. Again, a lot of compression. And then what ends up happening is the following week, you have that kind of window of opportunity for a little volatility to spike. I think that could still definitely be the case today. Again, a pretty sideways, choppy day. Nothing too exciting playing out. Now, granted, we did see manufacturing PMI come out better than expected. We're still seeing kind of this better than expected growth sort of economy. Obviously, stocks surprising everyone this year. No surprise to us. But the big thing that is now on my radar is what is happening with oil. I have been for some time now thinking, kind of anticipating that we would end up seeing oil push higher at some point. My thesis is effectively that, look, a lot of the cuts that happened in 2022, early 2023 were made on the premise that we would be in recession come, this time, right? Mid 2023. Obviously, we're in a way better than expected economy, growth much better than expected, a lot of money to be had out there. And so the oil producers at some point would be like, hey, I want my cut too. And it looks like they might finally be thinking that, right? That they're going to want their cut at this juncture. So we've seen oil really take off over the last few days. If you're a chart guy, you're an Elliott guy, you can see my count here on the chart. I think we are now heading into a wave 5 here. At the end of the day, I don't need oil to go higher. I just think that there is certainly the capacity for oil to go higher. And if oil really does start to take off here, right, and we really finish off this year strong, we head into next year even at even higher, more elevated levels, heading into maybe next summer 2024, I think this could be the beginning stages of some sort of kind of economic cycle endgame. So we're going to go through those dynamics tonight in this update and kind of explain how high oil could get or how high oil needs to get before the economy as a whole really just can't support oil at that price. That'll be the goal here. So hey, if you're not subscribed, get subscribed. If you end up finding this video helpful, give it a thumbs up as well. But kind of on to the analysis. I'm going to start with the most important chart. We've been over this many, many times, but the reason that we are seeing such incredible, better than expected growth is because of that additional interest income from the higher interest rates that continues to support this market. It's regressive. Yes, we've been over all that, but in real terms, as long as we are running a deficit in real terms, or in that case, a private sector surplus, but if we're running a federal deficit in real terms, that supports economic growth. That supports higher equity prices. The danger starts when we get into a real surplus, right? That mold flips, and the government is now extracting net financial assets from the private sector. One way we can do this, right? So the chart in front of you is the federal surplus or deficit as pulled from the daily treasury statement. I'm sorry, from the monthly treasury statement. It gets accumulated and then we adjust it for CPI. So this is in real terms, effectively the debt, national debt. So one way that this can kind of invert, right, is if CPI really starts to take off. And one way CPI can really start to take off is if oil really starts to take off. So what I'm going to do is take a look at this exact same data, but instead of adjusting it for CPI, I'm going to go ahead and adjust it for oil. Obviously a little more noisy than our CPI adjusted, but still it gives us some very interesting insights. You can see there's a kind of a bit of a danger zone, right? So y-axis down 0.5% in terms of contraction year over year. You can see that's kind of when we get into that danger zone for the rate of change. Heading into the 1980 recessionary period, 1990 recessionary period. There was an oil shock there. 2000, not so much like the oil shock per se. We were obviously just in at that point, not only a real but a nominal surplus at that point as well. And then the biggie happening when we had that huge run up in 2008, the big run up in oil again. So there seems to be this kind of danger zone. Similarly, we actually had the same dynamic play out in 2022. Obviously, we never got a recession, but we got about as close as you could come to a recession without actually getting a recession. And now we are obviously still very far away from that sort of dynamic playing out, but we're getting closer. We saw oil push higher at this point. So what price could the economy support? So what I did to try and kind of at least help you visualize how you could get at this is, instead of having oil be where it was at, right around $80 a barrel, I went ahead and adjusted this for $200 a barrel oil. And you can see if we adjust it for today, given where we are at today in terms of the current deficit spending today, $200 oil gets us pretty darn close to that danger zone that we were just talking about. And that's where I think the danger zone begins. I think this economy can support $200 barrel oil at $200 a barrel for an extended period of time. Maybe about $250 is really where we start to get to kind of the point of no return. But given current flows, I think $200 a barrel is a very reasonable target, and I think we could support that for a while. Now, this assumes that current spending remains at the same pace. One of the risks that we face if oil starts to take off, and we'll find out later this week, we're going to see what the Fed has to say about interest rates, but if oil really starts to take off and the Fed is still keen on hiking interest rates, that's only going to continue to add additional interest income to the private sector, diminishing any of the real effects of the higher price of oil on the overall kind of aggregate macro economy. So we need to take that into consideration, right? That if we see this continue to accelerate because of that additional interest income, that the economy can only will only open up more capacity, if you will, for higher oil prices to be supported at the macro level. So this is, again, an analysis, $200 a barrel today. This could change 6 months from now if we continue on this rate hike bonanza that we've seen from the Fed. Let's say the Fed gets it up to 6-7%. That will only add, the billions a month more that they continue to add in additional interest income. So we could see a kind of spiral upwards here. And this is always the fear of MMTers when you start artificially increasing interest rates above that natural level at zero, is you can get this reinforced cycle higher. So far, we haven't seen kind of the terrible inflationary effects of something like this as kind of the transitory side of inflation begins to fall off. But now that we're kind of outside of that window, this is where the dynamics can kick in. If the Fed doesn't, pull their foot off the gas here, we could see this sort of spiral upwards get out of hand, and that would be a risk. And we could just see oil really, or the economy really be able to support oil at a much higher rate. That remains to be seen. Obviously, the Fed is a monopoly price setter of rates. We can only guess at what they're going to do. We'll take them at their, we'll take them at face value. We'll see what they have to say this week on the Fed rate hike announcement on Wednesday. Yeah, we'll see what their game plan is. But again, for now, I think $200 a barrel today, given the dynamics, is about what we could support. Obviously, if you enjoy filling your car up with gas, that's going to suck. But nevertheless, the macroeconomy can sustain it. And that's when things start to get a little bit dangerous. So keeping a close eye on oil. I think the interest rate thing, those are the two big things that we want to be keeping an eye on. I think the Fed suddenly, in a very dramatic fashion, reverses the interest rate, starts to bring them down. I think that is a big risk. I think oil really taking off here is another big risk. But I think there is quite the capacity for this economy to support oil into quite a cycle higher here, which again sucks if you're just trying to fill your car up. But the reality is I don't see it as an immediate danger. but it is certainly the looming danger that I think, say, come 2024, will be it'll be what everyone's talking about at that time. Anyway, that's what I have for tonight's update. Before I get out of here, if you're an active trader, active investor, you like what I'm doing here, you like the analysis, the models, everything that we're doing from an MMT perspective, check out the Patreon, patreon.com/MMT Macro Trader. Multiple updates posted there each week. Yeah, check it out. Anyway, that's all I have for tonight. Good trading, everyone. We'll talk to you next time. Bye-bye.